Yeah, happy to talk about that. So the number one thing that I always start out with is step number one. Got to get units rented. So, you know, I always, hear stories from brokers where, properties have fallen into disrepair and there's these big, whole laundry list of big issues. And the story usually starts out with the fact that vacancy started to increase. So the number one thing you can always do to make sure that you're doing a good job managing your property is just make sure you're focusing all your energy on getting any vacant units rented.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Florek, currently 26 years old, married with 2 young children, and started investing at the age of 22 with just a 4-unit building and scaled up all the way to 31 units. He has a very impressive background. I kind of want to hear from his mouth, but thank you, Joel, for joining us on the show today, and I really appreciate it.
Yeah, thank you very much for having me here, Dwaine.
Great. So for the people who are not familiar, I know you're in the Indiana marketplace. Can you kind of elaborate a little bit more on your background and how you got started in real estate?
Yeah, I'm originally from Marquette, Michigan, all the way up on the shores of Lake Superior. Grew up with parents who would flip houses as we lived in them. So I'd move every year or two. Pretty much lived in a construction zone my whole life. Seemed like every room, even though we, finish it, there's still a number of projects left to go until we get a couple weeks before we post it up on the market for sale. Every now and then, my parents would keep properties when we'd move out of them as a rental. Most of the time, it was single family. Occasionally, it was small multifamily, a duplex or a triplex. So as a young kid, at 8 years old, I was helping my dad lay hardwood floors. I got to experience what it was like to do, every single type of, project that you can imagine in a house. We've ripped off second stories, concrete, plumbing, electrical, all that stuff. And I also got to experience what it was like to have rentals. When I went out to college, I went to Michigan Tech, got a degree in finance, trying to figure out what I wanted to do with my life. And I knew financial independence was one of the most important things that I needed to figure out, and I needed to figure that out fast. Given my background growing up with my parents and kind of to follow along in their footsteps there, I decided, why not go buy a small multifamily? So picked up a small 4-unit, lived in that, rented out the others, renovated, built up my portfolio from there. I moved down to Michigan City, Indiana, where my wife and I live now. So I've got properties up in Iron Mountain, Michigan, 23 units up there, a couple hours north of Green Bay. And then I've got 8 units over in South Bend, Indiana. Right now I'm focused on growing in the Indiana market, Southwest Michigan, some open to partnering up with folks for, if they're doing deals down in Kentucky or other Midwestern markets where cash flow is something that's, strong out of the gate. And I guess that's really my focus is value add plays where we can see strong cash flow to ultimately protect us over the long term. And then obviously with the value add, the goal is to, increase the value of that asset.
Yeah, your background is very impressive. And it's I got started a long time ago in real estate in the kind of the fix and flip game. I remember seeing my first road sign where it says real estate conference, and I was like, I'm curious about it. I always hear on TV get into real estate, and that's how I kind of got my exposure. But what's really impressive is that your parents was kind of that leapfrog for you to say, you know, this is something, because you're essentially like born and raised in real estate. So you're, you know, you said that you're in the bedroom where it's like half finished with the sawdust. You kind of smell the paint and stuff like that. So like, that's like you was bred into it. And then you went to get a background at school in finance. And so it's like, now you know the number side, and then you transition so quickly to getting your, you know, first deal, and then going up and scaling larger deals to now ultimately syndicating deals. So I just find that so impressive, that what's kind of lacking now in our generation, or, you know, past generations, that the kind of the self-awareness of what is really needed to get to the next level and be financially free. And you just kind of identified it. So you kind of set yourself up for the future, you know, to be very comfortable, especially now that you have a wife and kids. So that's very impressive.
Thank you very much.
So as far as the, you kind of answered my question within your intro, was kind of like that aha moment. But as far as you learning from your parents, you said they kind of started on some smaller deals. Was there any other transitional education that helped you to kind of look at stuff on a larger scale? Because I mean, 4 units is still kind of is bigger than like a single family, and then, you know, 28 units and stuff like that is bigger. So was there anything that helped you along the way to kind of educate yourself to handle those larger deals without being intimidated?
Yeah, you know, I guess a kind of multi-part answer here. Number one, school that I went to, Culver Academies, I was on a scholarship down there. It's actually here in Indiana, so not too far from where I live now. You know, I grew up in a small town originally, didn't really know many business owners, what have you. When I got to Culver, I got a chance to meet, you know, kids that come from families that have significant wealth. And when I got a chance to meet, you know, the parents who own those businesses, ran those businesses, I got to realize, hey, these are average folks. I mean, you know, they're just nice, genuine people who, they're not geniuses, but they just kind of figured out a need in the marketplace. They worked hard, they put together a plan, and they just hustled and you know, broke their back until finally they you know, pushed through. So that was kind of the first part of realizing that, hey, you know, the people who make it big in the world, they're no different than any of us, other than the fact that they got educated, they worked hard, you know, they focused. The second part, I will say, I started my career out of college as a program manager for an engineering company. We worked with U.S. Navy, U.S. Coast Guard. I was in charge of the fire suppression division. And, you know, 22 years old, just got out of college, and I'm having to put together quotes for 10, 20, 50, up to $100 million proposals. And I'm, you know, sitting there like, you know, what are they thinking letting me do this? But after a while, I started submitting more of these things. You know, I realized, hey, there's a simple process that we're following here. We're breaking down the project into its smaller parts. We're going and getting specific quotes, you know, numbers for all of those individual pieces. If there are certain things forecasted out, we're analyzing what those risks might be. It might be changes to, you know, the underlying commodity, you know, what metal is going into the ship or the component that we're selling. Is there a way that we can hedge that risk, or do we just need to, you know, implement some sort of inflationary rate to protect ourselves? We put a team of folks together who are really smart and know all of their parts and pieces, and collectively we bring our knowledge together to put together this quote. And at the end of the day, it's like, well, yeah, I mean, this $100 million quote is probably pretty good for what we can sell to our customer over the next 10 years and still be able to hit our profit targets. So when you're looking at, you know, real estate deals, whether it's a single family home, whether it's a fourplex, or my second deal, which was a 16 unit, it's all the same thing of just, you know, break down the parts and pieces. How large are your units? What's the condition of them? How much does a fridge cost? How much does flooring cost? You know, what's a roof going to cost when I need to replace that? Where are the risks on this property? And basically analyze that all, break it down into its parts and pieces, try and get as specific as you can to the numbers, and ultimately build up your spreadsheet and see what pops out at the bottom. And as long as you feel confident in all the individual pieces, what comes out at the end, you can be confident that that number's correct as well, assuming you got all your formulas correct along the way.
Of course.
But I would say that confidence that I was able to build in my job allowed me to have more confidence in understanding, hey, a larger apartment deal is no different than a small one. There's some different complexities that come with it. It's nothing crazy. It's just a lot more doors to go ahead and add into your spreadsheet.
Yeah, I like your approach. And like I said, that's like the best way to do it. If you're looking at it from a big thing, break it down to smaller parts. And like you had also mentioned before, that the other folks that you had mentioned, the other business folks that you were friends with, that they're no different than any of us. They work hard, they figured it out, they got the education, and they implement it. But the key thing is getting that confidence that you can do it. And it's also getting help from, your job skills that you learn looking at, budgets and different numbers and stuff to find out like, this is doable. And this is no different than real estate. It's running a business, it's running numbers, and it's implementation. So that's very key. So you have the 16 units and then 11 on top of that? So it's just 3 total buildings?
I've got 4 properties. So in Iron Mountain, I have a 4-unit, a 16-unit building, and a 3-unit. And then in South Bend, Indiana, I have an 8-unit property. That's 4 duplexes all in a row that I purchased as a portfolio. Nice.
As far as the 4-unit, for new syndicators listening onto the show that want to kind of take your footsteps, what was the process of you getting in that? And then also the next deal, if you can give us kind of like some numbers around that as well to kind of give some context.
Yeah, so the 4-unit was my first deal. So there was certainly a lot that I didn't know going into that. I've learned a lot since then. Purchased that for $125,000. I was fortunate that my parents were able to help with a note investment for my 20% down payment that I needed. I went with a commercial loan to buy that because I actually got under contract before I started my job. As soon as I got my employment contract, I made an offer, got accepted, started going through the closing process, started my job in the middle of that. And a couple weeks after starting my job, we had closed. So didn't have enough W-2 income behind me in order to qualify for some different financing. So what the commercial route, the kind of alternative, or I guess the ulterior motive, if you will, was that I wanted to build a relationship with the commercial side of a local bank, with the goal being I wanted to do additional deals in the future. So I thought, hey, take a little hit on shorter amortization, a little higher rates, but that may produce additional, dividends, if you will, in the future when I'm looking to do another deal. So again, got a little bit of a note investment, pay my parents 8% on that money. Bank financed the other 80%. I put in the money to renovate the units. I did that every night when I'd get home from work. And my second deal was a 16 unit. I bought that 10 months later. And that one I structured 80% bank financing, 16.5% second position note via the seller. And then after prorations, I only owed about 1.5% down. I got a little personal loan and ended up only putting $5,000 of my own savings down to be able to purchase that deal. Cash flowed really well out of the gate. Average rents were right around the $600 mark. Tenants paying all their utilities. Purchased it for $685. The seller note was structured on a 3-year balloon. So 3 years later, I had to pay them back. We actually just hit that back in February. So it's pretty exciting. Got the appraisal back on the property. It appraised at $910. Rents have bumped up now to about $725 average. New units are all renting for $750 when those come up for rent. But with that $910,000 appraisal, I was able to pay back the seller note, refinance, and also unlock another $140,000 line of credit that'll allow me to roll that money into another deal this year.
Wow, that's very impressive. I like that you got into a deal for $5,000, structured it in that way, and like I said, the creative mindset of kind of structuring that together seems intimidating, but like I said, you was able to kind of piece it in parts, organize it, and make it, like I said, it's very also impressive going in, cash flowing out the gate, increasing the rent starting off at 600. Now you said around averaging 750, appraising at 910. So you added so much, equity value, then able to pay back the seller, and then now roll that over to now looking at other deals. That's really impressive. So the next one was the you said you have two other ones as well. That's a 3 and 8.
Yeah. So it was after I bought the 16 unit property, it was about 18 months before I found another deal that really made sense for me, given some of my my financial constraints of not having too much available to invest. So it allowed me to kind of build up some cash, if you will, and purchased a small 3 unit building. That was pretty simple purchase. It was in Iron Mountain, made sense with my portfolio there, 20 units. So get up to 23. It cash flowed extremely well. Was able to purchase that in cash. And immediately once I closed, I put a line of credit against it. And then with that line, actually just 3 weeks after closing on the 3 unit, this 8 unit popped up. And I was able to pull money from the line and use that as my down payment. My 8 unit in South Bend, I purchased that 80% bank financing. The seller carried a 10% note on a 18-year balloon or 18-month balloon. And I put down the rest of the down payment.
Wow.
And that one, actually, that note just came due. And was able to pay back the seller no problem from kind of the savings that have built up from the cash flows off the property.
Nice. So how are you finding these deals? Is it broker relationships, or is it sending out letters, or is this referrals? How are you finding your deals?
So 3 of my deals came off the MLS, the 4, the 3, and the 8. In each case, I work directly with the seller's agent. I always like to do that when I can. If somebody brings me a deal, I'm going to work with them on that deal, but I'm always out hunting for stuff myself. So, so 3 of those came through the MLS, and then the 16 unit came from a lead from my carpet installer when I had my first 4 units. The sellers were trying to sell. They've been trying to sell for a year and a half, just advertising in the local newspaper, kind of word of mouth, if you will, but it didn't get very good exposure, in my opinion, which ultimately meant that not too many people even knew it was for sale, and allowed me to have a chance to get in there and work with them to structure that second position seller note for a low money down purchase.
And then when you found these deals, you said that they were cash flowing. Were they kind of inadequate rent that you can kind of modify through just changing out the tenant or doing some improvements? So what type of stuff that you're using to identify the value add deals that you're looking for?
Yeah, I'll focus mainly in discussing the 16 unit and the 8 unit property. Those are 2 pretty interesting case studies and pretty reflective of what I'm looking for now. The 16 unit had some exterior deferred maintenance, but it's nothing that prevented you from being able to rent it. I'm actually just now getting to addressing some of those exterior projects. So it's had, no limiting effect for me to be able to raise rents. Mainly it was just under rented. I mean, these are 1,100 to 1,300 square foot units, all 2 bedroom, 1 bath, or 2 bedroom, 2 bath. They all have a deck or a porch overlooking a lake right in town. It's right on the water. Everyone has in-unit laundry. They have a carport. So I mean, these are really quality units built in 1993. But the owners who were, the folks who had owned it, they were self-managing, and they had built it back in 1993. So they were going on 25 years of managing that property, and it just, frankly, they weren't being as aggressive as they were looking towards the retirement years of pushing rents on the property as far as they could. The town was going through quite a good boom of employers bringing in new engineers, bringing in manufacturing jobs. So there was a huge need for housing, which meant that there was certainly an opportunity to raise rents given how much demand there was. So I really have not done, frankly, anything out of the ordinary on that particular property. It's always nice when you can find those.
Yeah, that definitely sounds some good deals or good locations.
The 8 unit in South Bend, Indiana, that was an out-of-country owner, hired third-party management. They did a decent job of getting renters in who would pay the bills, if you will, on a regular basis. But, clearly no pride of ownership. The exteriors were, frankly, in horrible shape. The landscaping, you felt like you were coming up to a jungle. Tenants would just leave their stuff on the sides of the building. Nobody cared about it. Clearly the owner didn't care about it, so the tenants wouldn't care about it. So average rents were right around $618 to $620 a month when I purchased it. And within 18 months, I've got average rents up to over $730 a month, with new units renting for $800. Basically, I just went in and dug up the landscaping around the property, put in some nice landscaping fabric down river rock, planted some nice easy landscaping grasses that, just low maintenance, grow up on their own, kind of look like bushes, if you will, but pretty easy to maintain throughout the year. Painted the exteriors. My wife and I would go over and do that a couple times a week last spring. And that was really it. And then as units turned, I've done a little heavier lifting on interior upgrades, but nothing terribly out of the ordinary. It's just a lot of the flooring was tired, in need of paint, some issues with fixtures, what have you. A little worse condition than my 16 unit on the interior. So a little bit more work on the turns, but again, now those are renting for up to $800 a month, and extremely high demand on those. And then the other part of it was there were a couple, one in particular, really bad tenant, suspect they were, drug dealers. That unit was horrible when they moved out. It was a pretty painful process. After their lease was up, we did ask them to leave. And ultimately, that was one of the big things that kind of transitioned the property to a little bit higher end. It was in a phenomenal neighborhood. This was the ugly duckling on the block. I've literally had neighbors, tenants come up to me, shake my hand, say thank you for improving the property, for providing a better place to live. And with the rental increases that I've given to the other folks, they've all said that, it's justifiable. They know that they're still getting a good deal and that their life is much better now at the property. And all the stuff that people used to leave on the side, I sent everybody a note that said, hey, we've got work to do as the owners. We've got to take care of this now that we've purchased this property. Here's what we're going to do. We're asking for your help. Please keep all your personal items tucked away behind the property. Everyone has these little kind of backyard deck areas. So keep your personal items back there. Put your trash cans away in this one specific spot so we can have a little consistency here. And once everybody saw that we were doing work, they all chipped in and did their part. And I haven't had any issues. I haven't had anybody pushing back, no problems. So that's really turned out to be a great property as well.
That's a very impressive story, because not only that you made the physical improvements, but you kind of changed the overall culture of the property. You made the tenants a lot happier. They're now more acceptable to the increase in rent. And now for the future tenants that, if these folks don't work out or they leave, then you're bringing in new, higher quality tenants and a nice, performing, good looking property. So that's very impressive.
Yeah,
But
and from a financial perspective, I purchased that 8 unit for $345,000. Again, that's a little more than 18 months ago now. I had a broker's assessment done this spring, and they said that it would likely in today's market sell for between 525 to 575, given the extremely strong cash flow that comes off. It's a very, very low cost property to run.
wow. And just like it just seemed like it was just a little bit of love and care of the property, with no like major overhaul of like the building, and just kind of taking care of it and kind of reorganizing the culture there. You're able to improve the equity of the property by so much. So that's impressive. Now, like, you have that built-in equity that's going to build for the future. Now you can go expand that into your other part of your portfolio.
Exactly.
But before we move on to the next segment, just want to take a quick commercial break for our sponsor, and we're going to continue our discussion.
Yeah, happy to talk about that. So the number one thing that I always start out with is step number one. Got to get units rented. So I always hear stories from brokers where properties have fallen into disrepair, and there's these big whole laundry list of big issues. And the story usually starts out with the fact that vacancy started to increase. So the number one thing you can always do to make sure that you're doing a good job managing your property is just make sure you're focusing all your energy on getting any vacant units rented. If you got to go spend money on getting new appliances, flooring, whatever it takes, get that unit up and running, get that revenue coming in, because money solves a whole heck of a lot of problems. So you got to make sure you have money coming in so that you can go solve more problems. The second step in the process for allocating capital when managing an asset is highest ROI projects. That most likely is going to be on the revenue side. So unit upgrades or amenity upgrades that will allow you to charge higher rents. But you may also have instances where you can spend money on things that will reduce expenses. So for instance, on my 16 unit, when I first purchased that, the previous owners were simply replacing heating elements in the electric water heaters. And when I took it over, it seemed like every couple of weeks we'd have another water heater going down, and I'd have to have the repair guy coming out to fix that. So I nixed basically that plan and said, no, we're just going to start replacing all these water heaters that we're having trouble with. And that way we don't have to have these emergency repair calls coming in for that. Another thing that I've done on my 16 unit is expanding the area where we have for snow removal. So we switched from 2 dumpsters down to 1, pushed that over, built kind of a barrier, if you will, so it doesn't slide over. And then we cut out this embankment, and that significantly expanded the amount of room that we have for snow removal. Why that's important is every year I was spending probably about $500 to have snow literally just picked up and moved off the property because we would run out of room for snow removal. So by expanding this area, now I have $250 to $500 less in expenses every year, and it wasn't a very expensive project, just renting a loader or a little mini excavator for half a day. And moving some dirt around and getting in some gravel. So that's something that's been valuable as well from kind of the expense piece. So again, number one, get units rented. Number two, highest ROI projects. And then the last part is de-risk your asset. So our goal is to build investments that can produce cash flow long term. And if there's something that could significantly put that at risk, I want to go ahead and deal with that issue. It may be adding amenities to the property that in a downturn will allow you to be more competitive It may be dealing with some CapEx projects like a roof or what have you that you don't want to have leak, right? It's just getting old. It's time to move, put on a new roof. So I consider that a de-risking project. It doesn't add any additional revenue to the property, but it prevents the roof from falling through or leaking and causing a whole bunch of additional damage. In this past spring, we actually just got done with a project of expanding our retention pond and building an emergency overflow culvert for water. We knew we had water issues going into the 16 unit when I purchased it. So these couple of projects are going to prevent ever having a flooding issue in the property. So again, just something small that we're doing to de-risk the project long-term.
Yeah, some very good points. And that's like a perfect segue into kind of talking a little bit more about your syndication business as you kind of have future plans to kind of scale up for larger deals, and talking to that for potential investors to kind of let them know this is your bread and butter program that we do implement in all of our properties will give them kind of more peace of mind, more confidence to invest into your projects. Because you could kind of detail a little bit about your future plans and kind of some future projects you're working on as far as the syndication?
Yeah, so for me, the goal is really to scale up this year, whether that's partnering with other syndicators and coming on and helping in smaller roles on a general partnership, getting involved with a team on a deal down in Louisville, Kentucky, 107 units, signing as a key principal on the loan for that project. So pretty excited to be joining that team. I've got a deal coming along for myself here that I'll be excited to share a success story with the end of August on being able to close that up. It'll be a smaller deal, but first chance for some of the folks that have been really interested in working with me, investing alongside me, to get involved and kind of enjoying the passive side of investing in real estate while I focus on the active side of investing in real estate for them. But ultimately, the reason for me for scaling up was just looking at what are my goals for my family from an income perspective, from a lifestyle perspective. And what I realized is that I really need to have properties where I have on-site management, at the property, taking care of things, where I'm spending my time managing the managers as opposed to managing a lot of the day-to-day operational stuff, leases, different things that I'm doing right now. So I could have gone two paths. One is buy stuff myself and just do the refi and roll strategy, savings. That would be likely a long, slow process for me to get to the type of properties that I want to get to with on-site management. The alternative is partner up with folks, get a little bit smaller piece of a bigger pie, and go after the type of deals that I want to be in today. And for me, that seemed like the most attractive option to be able to get my family to the income and lifestyle goals that we have. Ultimately, my long-term goal is to own 500 units myself, split up amongst 3 or 4 properties and at least 2 metros. But for now, the goal is scaling up with other folks and building as big of a portfolio as makes sense and as is fun as well. I love doing this. I certainly don't want to push myself to the point where I'm not loving it. So,
yeah, that's very key. And one thing that I really want to touch on is that you started out with what is your goal? A lot of people just kind of jump into a venture, jump into real estate, not knowing what particularly what their end goal is, because that can affect ultimately what type of property you buy, the strategy. Is it local? Is it national? So it's good that you find, that you have a family and said, this is what we want. This is the type of lifestyle we want. In order to achieve that, then we have to go through a certain type of process. And you say, I'm going to partner up with other sponsors, start building up a little portfolio, and then ultimately having your own kind of portfolio that is, self-managed, where you can be able to kind of control your own destiny. So that's just right on the money there. Kentucky, it's a good market to do syndications. Is there any other marketplace that you hope to be in the future, or are you currently eyeing on right now?
Yeah, so for deals that I'm focused on sponsoring myself, there's some select markets in Indiana as well as Southwest Michigan that are stable, growing markets, have diverse employment opportunities, manufacturing, engineering, healthcare. I really like towns that do have a university base, although I'm not particularly interested in student housing. So I guess the primary reason why I'm focused in these markets is number one, I really believe that first and foremost, real estate investments need to work because of the cash flow that they produce. And more power to other syndicators or investors who are going after different markets. But I look at some of these offering packets where folks are putting on 3 years or 6 years of interest-only loans. Excuse me. 3 or 6 years of interest-only loans, 30-year amortization, and they're projecting these pretty substantial rental increases, and they're only hitting a 15% IRR. It kind of boggles my mind that if anything happens in the economy and we get a hiccup, that business plan is really going to substantially get hurt. They're protecting themselves a lot of times with 10 to 12-year terms, which is good. But still, at this time, I'm not comfortable with that. Given where we likely are in the market cycle. So I'm focused on properties that, we can achieve stronger cash on cash returns via the cash flow right out of the gate in the Indiana, Southwest Michigan markets. There's some other, markets within the Midwest, Kentucky, where you see those same kind of metrics, but you can still achieve, the fantastic returns via your added value that you put into the property over your 3, 5, 7, 10-year hold period, depending on the ultimate goal of your project.
Yeah, you're perfectly right, because I get sent a lot of deals to look at, to invest in, and I'm just running my numbers, and I'm like, this is very tight. Like I said, depending on the market cycle, is it properly stress test? And what type of mortgage they're trying to put onto it. So it's really just being careful, seeing if it's a real good opportunity, and understanding that, especially having the responsibility and the fiduciary responsibility of having investor partners on those deals, that now you're taking care of their money. And depending on what type of structure you are, you want to make sure you be careful and make the investor comfortable as well, because any little mistake can kind of just completely destroy your business and kind of destroy everything that you kind of built up to that. So you're taking the exact right approach and kind of just looking at it from a deal by deal perspective, being very cautious and analyzing numbers, and also having a financial background in the personal experience from your own portfolio of what's actually works, and testing out different things and able to increase your NOI on your own property, so you actually know it from being the boots on the ground. So that'll make investors even more comfortable in approaching you and working with you on future projects.
That's the goal.
So, like, kind of winding it down, I know you probably mentioned a couple of times about, your family man. So besides from not working, fixing up units and trying to build up your portfolio, what are you not doing when you're not working?
My wife and I met sailing through college sailing. So still very active in that sport. I do a lot of the offshore races, overnight races on Lake Michigan. So I have a lot of fun with that. I'll be out on the water this weekend, getting out for a race. So that'll be good. My wife and I love getting out to state and national parks. That's something that we think is pretty cool, getting out hiking, getting our daughter out there. She went camping for the first time when she was 3 weeks old. Nice. Which was pretty fun. Went to the Smoky Mountains, had her in this little tiny like tent crib, a little fold up thing. It was hilarious. She was just this itty bitty little thing. And we got a lot of odd stares from folks as we were hiking down the trail with her. But no, we love it. And then my daughter just, she never wants to come inside. She just loves playing outdoors. And for us, that's fantastic.
That's very cool because, like I said, I have two young children, and like I said, it's tough now with so much distraction with TVs and smartphones that they get the kids outside like how people used to do when there was less things to do. So it's actually nice that you're getting your daughter exposed early to outdoors and to make her love it, and then seeing what's out there, instead of just being indoors all day.
Yeah, absolutely.
As far as like your morning routine, so like what's kind of some tips for some syndicators that want to become and kind of follow your model, your mold? What's kind of like your morning routine? What are the things that you do to help you become successful?
When it comes to a morning routine, I tried the whole miracle morning thing. Didn't necessarily work out very well for me. I like to wake up when my body tells me that I want to wake up. So I love not having an alarm in the morning. So I typically don't schedule anything until ideally not until 8:30 or 9 o'clock. I mean, obviously there's sometimes you got to wake up a little bit early for a meeting or to head out somewhere. But I love just getting a chance to, wake up when my body feels like it's right. I get the morning brew newsletter. I love getting a chance just to read what's going on in the world of business and tech. There's a couple other kind of business newsletters I get for some of the local markets that I invest in. Love just getting to read those whenever there's something new that comes in. Just kind of see what people are doing. Make my daughter and my wife breakfast every morning by the time they wake up. And we honestly like to start the morning just a little bit slower, calm, and not get up and just start rush. I think the important thing with that and why I've stuck to that particular routine is it centers me around being slow and being patient, which I think in the world of real estate is an extremely valuable thing to have. Rent checks don't come in every week. They come in once a month. You sign year leases. The hold period is 3, 5, 7, 10 years. The folks who make the most money in this industry are the people that invest in real estate for 30, 40, 50 years over their entire lifetime. So, I'm a young guy, 26. I got a long time to go. I don't want to get burnt out. I want to keep this being fun. I want to enjoy it. So, for me, that's my morning routine. I really enjoy that. We like to go out on the back porch if it's nice and, eat our eggs and drink my OJ and, just laugh and talk. And then once my meetings get started, then I kind of put on the headphones, focus, get work done and kind of hustle for 2, 3, 4 hours, take a little break with the family, eat lunch and do it again later that afternoon. And the goal is that by evening we can cook dinner as a family and maybe go for a walk on the beach, head to a park, do something together. Very nice.
I know that you said family is a really big thing for you. Is anything else that you're most grateful for as well?
For us and us being myself and my wife, community is something that we really value. We're actually trying to figure out whether or not we want to actually move to the next town over, which we feel has a little bit better community feel to it. My wife's very involved in local YMCA and other organizations. I've gotten involved in some different organizations as well. So we definitely want to be able to kind of put our roots down and provide, additional value back to our community beyond just paying taxes and being customers at the local shop. So that's something that we're still working on finding, but it's something we spend a lot of time talking about.
Nice. So how do you, as an investor, as a partner, a potential partner, how do they get in touch with you?
Yeah, you can reach out to me at joel@jfhcapital.com. Jfhcapital.com is my website. Feel free to go there and send me a little a contact form link, if you will. And more than happy to get on the phone, talk with anybody, whether you're trying to do your own deal, you just want to talk real estate, talk markets. I love getting on the phone and networking with folks.
Awesome. Yeah, Joel, thank you so much for joining us on the call. Really informative, very inspiring, especially at your age, all the stuff that you're doing, kind of all your future plans, your whole process of investing, evaluating deals and performing is very impressive. So I want to thank you again. It was very good for our listeners. I hope people reach out to you, and we'll look forward to connecting with you soon.
Yeah, thank you very much, Dwaine, for having me.
All right, take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.